Hello traders, welcome back to a brand new video. Without wasting any of your precious and lovely time, let's get straight to what you are going to learn today. In this video I want to show you the only trading pattern that you can use without having any daily bias. You will just go straight to any time frame and start making entries. This trading pattern will be beneficial if you are scalping or having few days to pass your prop firm trading account. So, traders, I will show you the trading pattern that you need, with all the rules including the entry style, so stay tuned. Then I will also explain the range on price action, and this range can also be used with other trading style. It's just something that will make you to understand price action even better. And lastly, we will do few examples, so that you can start trading today. But before we begin with the pattern, you have to understand what is impulse and correction. Impulse set the direction of the market. You have to make sure that you catch the next impulse, so that means you will be entering your trades on the corrections. You will spot corrections in the market with a small candlesticks, or a consolidation market, where the market is moving sideways. It's just that in trading we have a lot of names that describe the same thing. And another thing, make sure that you are not in the wrong side of the market. You don't want to be bullish on a bearish correction, because you will be stopped out very easily, and especially those traders who doesn't use a stop loss. This is where they are easily being stopped out, or blow their trading accounts. You also must understand the market structure. This will help you out to understand where the market might potentially reverse from, so that you don't catch small pips. During a bullish move, before the market can reverse, price action must break the last higher low with an impulse. Before we can consider the market to be reversing, we can see that the market broke the last higher low with an aggressive move, then the market corrected here, before we can see another bearish trend. The market moves in waves, so when the market is trending you will see that you will have impulses and corrections. And another thing is that, mostly on the last move, the market will start to be very slow. You will notice it by having candlesticks that are very small with bodies. Talking about candlesticks, you also must understand the open and the close of bearish and a bullish candle. This will help you when confirming your entry, and you also must understand how a candlestick behave. But let me show you a simple way to understand it. Here we can see that we have a bearish candlestick. It will open here. It will start by opening, then it will move to make a high. Let's say this is our daily candlestick. It will make the high of the day. Then it will drop lower to make the low of the day. But before it can close the day, you are most likely to see a slow move going up. And then here, where the market was just moving lower aggressively, a candlestick will form what we call a body. You also must understand how to draw supply and demand zones, or order blocks. You can just call it whatever you want. You also need to understand what a confirmation candle is. If you don't know what confirmation candle is, you can watch this video on the top right. Then you can come back to this video. The video will also be in the description below. Please have a pen and paper and draw this pattern down, because I must explain it in details. We have two types of entry pattern. This one here is our reversal pattern. It looks like Quasimodo pattern. We can conclude that this is a Quasimodo pattern from Harvard. This pattern, even on a continuation, it will still look the same, but missing only the one thing. Let's do a full illustration so that you can understand it step by step. Let's say now you have a bearish trend like this here. Then the next step is to wait for the market to make a new low. The new low will be created like this. Then you will wait for the market to break that created new low. When price trade below this low, you will wait again for price to break the market structure by trading above last previous low or high. Now when you have this, then you can incorporate some of the trading rules to make this setup to make more sense. Then you will wait once more for price to correct or consolidate and create a new low. Then price must trade below this newly created low, and sometimes it can be hard to spot this created low, but once you put more practice into it, you will see that it's happening a lot of times. Now you must find a demand zone or an order block plus a fair value gap below that newly created low that needs to be broken. Now we can see the imbalance here. An imbalance is a space between the wicks in simplest terms, so that means we will wait for price to trade lower and close the fair value gap, and then touch our demand zone, before we can see price going higher. Then your full analyses will look something like this. So the next thing is to wait for price to trade lower and touch the zone and close with a bullish candle. before you can take a trade. That bullish candle will be your confirmation candle. Now that we have a confirmation candle, then we can decide if we want to sniper the entry or enter at the close or not. But the recommended video will explain everything about confirmation candle, so make sure you watch and understand it roughly. Then your trade setup will look something like this for someone who will be entering on the close of the candlestick. And don't forget to add few pips below the stop loss for spread, because you know this trading brokers like to take our money. And for take profit, we will be looking to target previous highs. Let me explain the range, because we will be using only one time frame. On the left, when the market is impulsive, you will be looking for few candlesticks, like for example, we can see that we have 7 candlesticks on the impulse. Then here on the right, before we can take a trade, we will be looking for the market to have more candlesticks, and we can see that we have 19 candlesticks. This is a sign that the sellers are not enough to push the market lower. So if you have the same candles going up and going down, let's do one practical example on a chart. Here we can see that we have a bearish trend this side and then a bullish trend this side. So let's see how all the rules can apply here or not. We will go step by step. Here we can see that we have a previous high here. Then price traded lower before trading above the previous high. Now we can also see that we have a low that I have mentioned that price has to trade below it. So on the last few steps we have to find a demand zone, a fair value gap, and lastly a confirmation candlestick. We have spotted an imbalance here, and we can also see that the imbalance is below the low that needs to be taken out. We will draw the demand zone on the last bearish candlestick before a bullish trend that broke the previous high. Finally, you have to wait for the market to touch the zone without trading below the zone and close with a bullish candlestick. That will be our confirmation candle. And if price trade below the zone without closing bullish, it will make the whole pattern to be invalidated. Let's also look at the range. We can see that the market moved higher with 8 candles. And then before we can take an entry following all the rules, price went lower with 17 candles. Then this is a sign of weakness in the market. On the second example we will do a bearish example. We will follow all the rules again, or you can pause the video and try to predict how the market will behave. Let's find all the rules now. We can see that price spiked above the previous high. This will also trigger buy stops of some traders. You can also call it buy side liquidity. Then now we have to see if we have a break of market structure or not. We can see that we have 2 break of market structures, the first one being the major break of market structure, or you can say a bigger break in market structure. Then lastly we have an internal break of market structure. So lastly what we need to do is to find a bearish order block, or a supply zone, where we will be looking to take a sell position. Now that we have a supply zone here, we need to add a couple of more things to our analyses. But firstly let's find our fair value gap. You can pause the video here and try to find the fair value gap on this impulsive bearish trend. We can see that we have an imbalance close to the supply zone. This is a good thing because we will be looking for the market to close the imbalance and then touch the supply zone. Your overall prediction will look something like this, or you can say your signal to take a sell position will look something like this. So now let's see how the market unfolds. From here we can see that the market made a small high here. Then, now we have to wait for the market to trade above that high and close the fair value gap, and to also touch the supply zone, before we can take a sell position. So now we can see that price touched the zone and closed with a bearish candle. This is where you should look to take a sell position. And guys, please take note that you have to calculate the risk inside your trade setup, because even with a better trading strategy with rules, you can still blow your account with poor risk management skills. Then you will enter the market like this. Your bearish candlestick is your confirmation candle. Your stop loss will be above the supply zone, with few pips added for spread. So now let's see how this trade played out. See how easy it is. And also guys, don't forget to see how many candles reach the zone. I guess this is the end of our video. If you have enjoyed this video, please consider supporting the channel by giving us a like and share this video to your friends who are still struggling into trading. Then also don't forget to subscribe to the channel. Maybe we might reach a 100,000 subscribers by the end of 2023. For continuation, it's pretty much simple because you can just enter the market without having too much technical analyses on your chart, like from this example. We will close this video with this example. This last example will show you that even if you lose a trade, you should never give up, just keep grinding, bro. It takes time to be a better trader. From your host, Easy Forex Strategy. I will see you guys on the next video. I love you all.